What is going on, my fellow income investors? Welcome to the channel. I am the covered call guy, and for those who are new, my goal here is to create $120,000 in annual passive income with my 7 current holdings: GPIX, QDevo, GPIQ, IWMI, SPY-I, QQI, and iDevo. With these 7 holdings, I'm currently yielding about 70 grand a year, translates to about 5.8k a month, 1.3k a week, $193 per day, and about $8.05. Legal disclaimer before we start this video: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube, and I could be completely wrong. All right, with that out the way, let's get started on today's video. It's going to be on a great ETF that it's been getting some trending so far, and you know, I'm not sure if anybody else has mentioned it, but the ticker symbol is OVL, and we'll be doing a deep dive. So welcome to this video of a complete breakdown of the Overlay Shares Large Cap ETF. And today I'm going to be analyzing the true yield, the actual fees, and the structural risk you need to understand before investing in this. And it caught my eye for several reasons. All right, so we'll talk about it. All right, so let's talk about the bad of this. All right, so what caught my eye is, yes, it does have a high cost and low yield. So let's start off right at the bat with the bad news about OVL. Yes, you are paying a massive 0.79% expense ratio for, yeah, a pretty pathetic 4.9 trillion yield, right? So when passive index ETFs charge just 0.03%, this active fee heavily destroys your net income, right? It's the drag here. And since inception of 2019, this $178 million fund has consistently fallen short of the 8 to 12% yield targets that many derivative income investors like myself and possibly you, right? So if you want massive monthly cash flow to survive retirement, you might be in the entirely wrong place, putting a lot of allocation here. All right, so the bad: crash amplification. So, you know, as you know, what's going on right now, the financial industry does love to pretend that put spreads offer downside protection, but I'm here to tell you they don't. It's pretty much almost like a mirage, right? Selling a put option often create a synthetic long equity exposure, meaning you eat the underlying losses during a panic. So going back to 2022 inflationary crash, right? OVL plunged a massive 22.2%, actually amplifying drawdowns, right? You got zero downside buffer here, right? The ecosystem, I'm gonna say it's pretty, you know, tier 3 NAV destroyers, right? Capped and candlelight. So in the $127 billion ecosystem, you do have to avoid tier 3 yield chasers. And what do I mean by that? Well, these are the QYLDs. They write at the money calls for a 12% yield, but mathematically guarantees permanent NAV decay over a decade. Extreme concentration, like FEPI and AIPI, right, offers an insane 25 to 35% yield, but because of the extreme tech concentration, it makes them extremely volatile, right? These are absolutely great NAV destroyers, right? And you should reconsider holding them long term if you have any of these in your portfolio and you're starting out and you thought the yield was just nice and it was too good to pass up. Well, yes, you should have passed it because it's too good to be true. All right, the ecosystem still going on tier 3 is the synthetic traps, right? If you are using 0-day time expiration, and if you don't know what you're doing, and it's essentially gambling here, right? It does get worse with the new 0-day time expiration. I'm gonna say gambling funds like XDTE, QDTE, and possibly even JEPY, right? JEPY, but with the Y, right? Because they peddle weekly options anywhere from 37 to 50% yields, 51% yield, right? They are taking on a more massive capital destruction for a quick buck. So understand that part, right? Lethal tail risk. So SVO OVL, which shorts the VIX to pay 16%, but exposes you to lethal fat tail blow up risk. So, TLTW yields about 13.38%, but then it gets completely obliterated when interest rates rises. So with a lot of things going on, there's a possible chance that interest rate will go up. Okay, the consensus here, right? Better prices performance, but dividend yield is way below others. That is my consensus when I go on Reddit and I'm looking at what people are saying. This is what I'm getting, right? Let's look at what real investors are saying, right? One user noted the lower yield hasn't been above 4% since 2019. Checked it, and it seems to be quite true, right? And some people do care about the yield, right? Some people just want a bit juicier yield, right? The community takeaway is completely correct. At least I did my little fact check. You can fact check me in the comments, right? OVL is a growth plus income play, not a pure income ETF. So take this as you might want to. OVL is a growth plus income play, not pure income. So now we understand why they have such a higher expense ratio, and possibly they have a lot more stringent active management needing to pick the right stocks for growth. All right, so let's look at the gray. There's the gray area, and this is the engine part, right? What is underneath the hood? So how does OVL actually generate $2.53 annual distribution? Well, at least I came to this conclusion that the fund puts nearly 100% of its capital directly into Vanguard SP 500 ETF VOO, right? It then uses the remaining collateral to execute an off-balance sheet put credit spread. So you are basically holding the S&P plus a synthetic income overlay, leaving diversification extremely limited. Good or bad? Let me know in the comments if you like this or not. This is the gray area here. This is where, okay, what is the point? Perhaps there is better options out there. Okay, distribution mechanics, right? So I think this is their structure, their strategy. Sell puts to generate cash. OVL sells short-term puts options to collect upfront premiums from the market volatility. This is where you get your payout. Then they buy the put, right? It simultaneously buy lower strike puts to limit this disaster risk, defining your absolute maximum loss. Consistency here, I think recent payout does show a moderate consistency of 46 cents, rounded up 47 cents, give or take, right, in February 2026, right, and 47 cents in January, 41 or 42 cents, just about 42 cents in December 2025. So quite consistent. It does fluctuate, but this is quite consistent in terms of option payouts. Okay, this is great. Okay, the volatility problem. So compare it to JEPI and SPY, right? Institutional investors look closely at risk-adjusted metrics, and you should too. And OVL shows an aggressive profile. Okay, JEPI operates with a tight defensive 13.32% standard deviation, so it's giving you remarkably smooth ride here. OVL tracks the raw base volatility of the S&P 500 plus the added synthetic long delta of its put spread, so that makes it a much more rougher holding. Perhaps you could even say it's much more aggressive than JEPI or SPY. Okay, the ecosystem tier 2, elevated yield. So let's look at the tier 2 part of elevated yield. This is the tax advantage part, right? So moving up to tier 2, we have to find funds that trade away your long-term compounding for bigger monthly check. Well, some people are okay with that, and these fit into the category of JEPQ, right? Gives you 11.18%, but ties your fate to the turbulent Nasdaq 100, while QQI and IWI uses a more efficient tax efficient accounting return of capital to safely put 12 to 14% without immediate decay, and they've been performing very well, right? Capped compounding. So I Spy and Belly does offer 7 to 10% on a core S&P 500 framework with much cheaper fees, right? These funds execute well and they explicitly cap your growth potential. Some people are okay with that because they're there for the money. Okay, the good. Let's talk about the good of OVL. Okay, this is what I do love about OVL and why it possibly could hold a place in my portfolio. This is my absolute best part of OVL. It does not cap your upside like traditional cover call ETFs. French kiss right there, right? This is the growth part. Right, a lot of people are saying I am the capped cover call guy. Well, perhaps I'm gonna have some OVL, and now I have no cap, right? So in a raging bull market, the short put expire worthless, and you keep all of the premium plus the S&P 500 gains, right? So OVL captures a massive, it captured a massive 23.8% to about 27.9% total return in the past year, and 14.1 to 17.9% in 2025, right? So it is a total return monster hiding in an income wrapper. Let me know what you guys think. Pause the video, timestamp, let me know what you think. This is the absolute good and beautiful of this cover call ETF. All right, so it is growth oriented first and then income, right? So play this ETF as it's just that. It is VU with a little bit more juiced up income. Just think of it that way, right? So the good, NAV preservation, right? It has a moderate yield target, roughly 4 to 5%, right? Because OVL keeps its yield moderate at roughly 5%, it doesn't need to over distribute to pay you, okay? Strong suitability, sustainability rating. This is my opinion, of course. Okay, I do think this aggressively protects your underlying principle from cannibalization we see in high yield traps, right? Its sustainability score is incredibly strong, my opinion, because the equity growth easily helps maintain the NAV. Okay, it's a 4 to 5% annualized yield. That is not and should not be hard to maintain. It is essentially just a little bit, tiny bit juiced up SCHD. That's it. That's it. Just think of it that way. And it plays the VU. All right. If the VU collapses, and the whole world has collapsed. I mean, I'm pretty sure this is pretty sustainable. I'm saying nothing's forever, but this is pretty much forever. Okay. The good, tax efficiency loop. So I do believe it uses Section 1256 contracts. So I could be wrong, but I think I'm right on this. OVL utilizes broad-based index options that qualify for highly lucrative IRS Section 1256 tax treatment, right? 60% gains are tax favorable long-term, regardless of your holding period, right? Crushing the ordinary income. So while you guys that love JEPI and JEPQ, right, they're classified at ELN, and structured products are as brutal ordinary income. So if you hold OVL or SPY and taxable account, you keep more of your money. Right, ecosystem of tier ones. Let's look at the kings, right? So how do we define the kings? One, in my opinion, is pure cash flow, right? So if you want pure monthly cash flow, SPY is your tier one, delivering 12.7% safely using out of the money call spread, unmatched armor. I still believe JEPI should be around tier one by offering unmatched downside armor with a cheap 0.35% expense ratio fee, right? And of course, hybrid growth. So for hybrid growth investors, if you don't like Devo for whatever reason, perhaps you like OVO, and perhaps maybe even GPIX, right? I do believe these take the crown by preserving your long-term equity appreciation. Okay, we never want our principal to go down. Never touch the principal. Everything else fine. Okay, actionable. All right, who should buy OVL? That's now that we kind of have a scope of what OVL is, right? Who should buy it? I believe core replacement. OVL fits perfectly as a S&P 500 core holding replacement, or a growth friendly income allocation. Growth seekers, right? I do highly recommend it for income investors who desperately want long-term growth and refuses to accept heavy NAV decay, like myself. And if you like following my path, perhaps this is now on your radar, perhaps this is now on your watch list, or perhaps you already own it, and you know what? Hopefully my video has given you a bit more information, and now you're really adding allocation. All right, who must avoid this? All right, however, if you are a retiree needing 8 to 12% pure income to survive, obviously avoid this ETF entirely, because again, it is growth oriented first, and then they will pay you out whatever they will pay you out, right? So again, take it as it is. It is a growth oriented ETF, and income second. All right, actionable final ratings. Again, these are my opinions. Out of a 10, I do give it a 7.4. I did aim it higher, but I revised it down from an 8 out of 10 to a 7.4. Why? All right, this is my reason. I'm officially revising its overall score down from 8.1 to 7.4 out of 10 because of the bloated expense ratio. You know, guys, I do love low expense ratio because of its drag. Okay, lower relative yield. All right, for those who want a little, I like at least a 5% and above. That's just me, to maintain at least a 5%. Sometimes this can go down to a 4.1 to 4.6, and then of course the crash amplification hold it back from being a pure income king. That is why I took it down, but I would bring it back up to an 8.1 or an 8 if you know, I add it for pure growth first and then income. I still give it a 5 stars out of 5 for its growth potential. Based on my deep dive, I could be wrong again, fact check me. I do give OVL 5 stars for growth potential, but only 3 stars for yield strength and risk level. That's it. Because of the amplified drawdown, the strength yield, obviously for those income investors like myself and you, perhaps this could still be a core position, but the allocation to it might not be as great. Okay, so the master data matrix of the core ETF that I kind of compared it to, obviously I put it against JEPI's by I, Devon Q, YLD, and how I kind of came to conclusion on, you know, how it fits, the good, the bad, the ugly, the gray. This is what I used OVL against. All right, so pretty much FEPI, XDTE, GPIX, QQI, SVOL, and this is pretty much how I came to my conclusion. You know, I have the core ETFs and then the aggressors, and you know, I do think OVL is going to be an interesting one. I hope I put this on your radar, and if I didn't put this on your radar and you already own it, let me know what you think of it. Did I miss any information? Perhaps you learned something new, and if you did, you know, let me know. If it strengthened your thesis and your conviction, let me know too. I'm interested. I'm obviously interested because I don't want to always be completely capped, right? So I do want some pure growth. So it is on my radar here, and perhaps I put it on your radar too. Hopefully this video was informational. You got something out of it, and of course, if you did, subscribe, comment, like, help the channel grow. Appreciate you guys watching. Stay tuned. Catch you guys on the next.